Welcome to Breaking News to Trading Moves. Today, we're looking at a development that really pulls the focus away from the components that have, well, gotten all the attention in the artificial intelligence build-out.
That's right. For what feels like a very long time. I mean, over a year, every conversation, every market move, it's all been fixated on one thing.
The graphics processing unit.
The GPU.
Exactly. The scarcity, the cost, everything. But something happened at the Consumer Electronics Show, CES, that was tied to some messaging from Nvidia.
Okay.
And it brought this intense focus onto a completely different layer of AI infrastructure.
And that would be data storage.
Data storage, yes. And that one piece of communication prompted a pretty immediate reaction in the market.
It created a clear headline, didn't it? The central idea being that the just enormous demands that AI places on storage, and we're talking about fast, high-performance flash storage, that this is creating a bottleneck in the whole infrastructure supply chain. You know, you can put it pretty simply. The data is just piling up, and the need to get to that data quickly is outpacing what the hardware can actually deliver.
And you said the market moved on this observation.
Instantly. After this messaging came out, we saw a really noticeable surge across the whole storage sector. The most visible name was SanDisk, ticker SNDK.
SNDK.
Yep. And at the time, it hit a record high valuation.
So that's our goal for today. We're going to go through the analysis of this market observation.
Yeah.
We'll lay out the rationale for why this demand for storage matters so much now and explain how the technical needs of modern AI systems have really changed the math on how you spend your money on infrastructure.
And from there, we'll identify the companies that have been categorized as potential winners and, on the other side, potential losers from this development. And it's important to note, this is all based purely on the analysis that was provided.
Great. So let's get right into the core market catalyst. Where do we begin?
Well, the starting point has to be that market indicator we just mentioned. The record surge for SanDisk, SNDK.
Right.
It was more than just a stock popping for a day. It was a powerful signal that investor sentiment, how people feel about the value of storage in this AI era, had changed.
And it wasn't just confined to one company. I think that's a crucial point.
Yeah.
This wasn't just a SanDisk story.
Not at all. This positive reevaluation, it extended to other established players in the storage industry. You saw Western Digital, that's ticker WDC, and Seagate, STX, both see a positive turn in their outlooks.
So the market started to recognize a potential tailwind for the entire sector, all generated by these AI buildouts.
That's it. Which brings us to the central argument here. Why has storage all of a sudden gained this level of prominence?
Because for so long, it was just about the GPUs.
Exactly. The narrative is evolving. It's not just about how many GPUs you can deploy anymore. I mean, yes, GPUs are the engines. They provide the raw compute power that AI needs. But they're only as effective, and this is the critical part, they're only as cost efficient as the speed at which they can get to the data and process it.
That sounds like a technical limitation, but what does that mean in practice? I mean, we all know AI models, especially large language models, are getting bigger and more complex almost by the day.
They are.
And when we talk about inference workloads, which, just to be clear, is when the model is being actively used to get results, which happens way more often than the initial training phase, we're talking about managing these massive scattered data sets. So why can't traditional storage handle this?
That is the perfect question, because it gets right to the heart of this architectural bottleneck. Traditional data centers, they often relied on spinning hard disk drives, HDDs, for cheap bulk capacity.
Right, the old school stuff?
And maybe some standard SSDs for faster access. But AI, and especially inference, requires extremely high. They call it input-output operations per second, or IOPS. And it's mostly random read operations.
So random, not sequential. It's not like streaming a movie.
Not at all. Imagine you have hundreds of GPUs, and they are all simultaneously asking for tiny little scattered pieces of data from a model that's spread all over the place. That random access pattern, it just kills performance on slower storage.
And that forces the infrastructure down a specific path.
It forces it to rely heavily on fast, non-volatile memory express, or NVMe, solid-state drives.
NVMe SSDs.
Yes. NVMe lets the system's brain, the CPU, talk directly to the SSDs over a super high-speed connection, which cuts down on latency in a major way.
And if you don't have that, if the storage isn't NVMe fast,
then your GPUs, these assets that cost tens of thousands of dollars a piece, are spending precious milliseconds just sitting there, completely idle, waiting for the data to show up.
And that waiting time, that latency, it just destroys the entire efficiency model of what people are calling an AI factory.
Absolutely. It makes the whole operation way too expensive.
So the technical requirement isn't just for more storage, it's for a very specific tier of storage, the fastest, most responsive kind you can get, and that completely changes the cost calculation.
It really does. The need for this ultra-low latency flash, it changes the whole ratio of the AI factory. Storage, specifically these fast NVMe tiers, is becoming a much larger and much more expensive percentage of the total infrastructure cost.
Compared to older data centers.
Oh, massively. You need those lightning-fast drives to make sure your GPU utilization rate stays as close to 100% as possible.
And if it doesn't?
Well, think about it. If your $40,000 GPU is just waiting around 20% of the time, that's $8,000 worth of wasted capital per GPU, per year. It adds up incredibly fast.
Wow. Okay, that explanation of inefficiency really clarifies why this became a market-moving event so quickly.
Yeah.
So let's look at the implications for market dynamics that come from this. If demand for these high-speed parts is spiking and the supply is either limited or expensive to make, the analysis points to a direct outcome.
Improved pricing power for the memory and storage suppliers. They're selling something that just went from being, almost a commodity component to being an essential performance-critical asset. And it's an asset in the world's most aggressive capital expenditure race.
So that gives the suppliers leverage.
A lot of leverage to command firmer pricing, to get better contract terms.
And the other side of that coin is just as important. It implies higher component costs for the biggest buyers of this equipment.
Correct. If you're a hyperscaler or a big corporation building out an AI factory, your input costs for those critical NVMe SSDs and the memory that goes with them, they just went up.
So it creates this clear zero-sum dynamic. The suppliers gain and the users of the storage.
The users of the storage pay. It creates a pressure point. The question isn't if AI is driving demand anymore. We know it is. The question is who is going to absorb the rising cost of making it all work.
Okay, let's start identifying the players involved here, starting with Category 1, the potential winners. The rationale for this whole group is that companies who supply or use these flash-heavy, faster storage architectures are the immediate beneficiaries.
They stand to gain from more unit demand and, crucially, from potentially firmer pricing across that whole memory and storage supply chain.
And we can break this down into 3 distinct groups.
Right. We start with Group A, the core flash, memory, and storage makers themselves, the companies that actually manufacture the chips and the components.
So they get the most direct benefit.
The most direct. Increased volume, better pricing, especially if data centers all over the world start needing more of this high-end flash storage and faster NVMe SSDs.
Let's go back to the first mover we talked about, SanDisk, SNDK. It was the main indicator of this change in investor sentiment after the CES news. Why SNDK specifically? Why was it the bellwether, especially since a lot of the demand is for enterprise-grade stuff?
Well, the SNDK surge, it really highlighted the basic commodity connection. I think investors just very quickly recognized that a surge in demand for any high-end flash memory helps drain the global inventory.
So rising tide lifts all boats.
In a way, yes. It benefits all flash providers. And while SNDK does sell a lot of consumer products, their underlying technology is flash. But the benefit goes way beyond just that one name.
Okay, so who else is in this group?
We also have to include Western Digital, WDC, and Seagate, STX.
2 huge names in storage.
Exactly. WDC is a major supplier of both the traditional hard drives and NAND flash memory chips. STX, while they've historically been more focused on hard disk drives, they're moving very quickly to expand their enterprise flash portfolio to meet this new demand.
So both are positioned to benefit from just this general upswing in demand for massive data capacity.
Which increasingly means either hybrid solutions with both flash and hard drives or just pure flash in that top performance tier.
And there's one more big one in this group.
We absolutely have to talk about Micron Technology, ticker MU.
MU.
Micron is a giant producer of both DRAM, that's the dynamic random access memory, and NAND flash memory. And the AI infrastructure build-out, it needs both. You need high-speed DRAM for the GPU buffer, and you need fast NAND for the storage itself.
So if pricing strength returns, which this analysis suggests it will because of AI demand,
then MU is perfectly positioned to capitalize. That turns directly into better profit margins on their memory products, which is exactly what investors want to see.
Okay, let's elaborate a bit on this idea of firmer pricing, because that seems to be the core financial lever here. I mean, historically, the memory sector has been very cyclical, right? Prices crash, margins get compressed.
Brutally compressed, yes.
So why is AI different? How does it create a more structural move toward firmer prices instead of just a temporary spike?
I think it's structural because AI doesn't just demand generic flash. It's not like the flash in your phone. It demands enterprise-grade, high-endurance flash. It's often based on specific architectures, TLC or QLC NAND, that are optimized for millions of write cycles and these massive random reads we talked about.
And those are higher margin products for the manufacturers to begin with.
Much higher margin. So when a massive structural demand driver like AI infrastructure comes into the market, it doesn't just absorb the old inventory. It rapidly pushes the entire industry to prioritize making these high-margin enterprise spec chips.
Which lifts the average selling price, the ASP, across the whole sector.
That's it. It gives them the ability to charge more per gigabyte. That means higher revenue and, most importantly, improved profit margins. And that is the metric that investors in this industry watch like a hawk.
So it's not just a recovery from a cyclical downturn. It's a reprioritization of their whole product mix toward the high-value end, which is more sustainable for them.
Precisely. It allows them to, at least in that high-performance tier, break free from that traditional boom and bust cycle.
Okay, that makes sense.
Yeah.
So moving on from the raw component makers, we get to Group B, the enterprise storage systems and flash array vendors.
Right. So these are the companies that don't just supply the NAND chips. They engineer the complete, sophisticated storage appliances, the boxes that house and manage thousands of those chips for big corporations and cloud providers.
And their rationale for benefiting is tied directly to those performance demands we discussed earlier.
Exactly. More AI deployments mean you need more than just chips. You need robust, integrated storage infrastructure. Businesses and cloud clients, they're looking for specific performance metrics: throughput, latency, reliability. And only these engineered systems can really guarantee that. They're buying a managed solution, not just a pile of parts.
So when you look at the names in this group, companies like Pure Storage, ticker PSTG, and NetApp, NTAP that, what is the specific value they offer in an AI environment that, say, a hyperscaler couldn't just build themselves with raw components?
The value is in the software. It's in the control plane, the management layer, and the reliability guarantees. Take Pure Storage, PSTG.
They're known for their all-flash arrays.
That's their specialty. And their software is optimized for things like non-disruptive upgrades, high data compression, and critically, for maintaining that ultra-low latency across massive petabyte-scale storage clusters.
So they're selling consistent performance under extreme pressure.
Exactly. When a machine learning engineer needs to be absolutely sure their model training or inference is going to run without any slowdowns, they rely on a company like PSTG to manage all that complexity for them.
And what about NetApp?
NetApp, or NTAP, is another major player. They focus a lot on data management and hybrid cloud solutions, but they too are expanding their all-flash offerings. It's really important to see the difference between needing the raw flash components from Group A and needing these integrated systems from Group B.
The systems are more than the sum of their parts.
Far more. A raw NVMe flash chip on its own is, well, it's useless without the complex controllers, the sophisticated software, and the high-speed interconnects that allow a massive AI cluster, which could be hundreds or thousands of GPUs, to access that data all at once without, tripping over each other.
Let's focus on those metrics again.
Yeah.
Throughput and latency. We established latency is the enemy of GPU efficiency. But how do systems from PSTG and NTAP specifically help manage the throughput you need for scaling AI?
Right. So throughput is the volume. It's how much data you can move per second. In AI, you need both low latency, which is a fast start time for the data transfer, and you need massive throughput, a huge volume of data moving continuously.
So the pipe has to be both quick to open and very, very wide.
That's a great way to put it. And these enterprise systems are designed with specialized hardware and software to maximize what's called parallel I/O. They can handle thousands of independent data requests at the same time. They use protocols and architectures that are custom-tuned to prevent that GPU cluster from ever starving for data.
And that maximizes the efficiency of the whole system.
It does, and it minimizes the total cost of ownership. If an enterprise system can guarantee that every single one of your expensive GPUs is fully utilized, then the premium price you pay for that storage system is very easily justified.
So Group B is selling a guarantee. The guarantee of performance and efficiency that these mission-critical, large-scale AI deployments require, that makes their upside very clear if the spending is moving beyond just the GPU.
They're selling the architecture, the management, and the promises of reliability and speed that these complex, high-demand AI environments absolutely need.
That brings us to our third winning category, Group C. This group includes the data center infrastructure players, the picks and shovels companies, as they're often called, who ride the wave of these storage-intensive AI builds.
The rationale here is comprehensive. If storage is now seen as a primary performance constraint, then the spending has to expand. It can't just be on the GPU and the flash array. It has to go to the whole ecosystem that supports them.
So, servers, networking equipment.
Exactly. Specialized servers, high-speed networking equipment, and integrated systems designed to handle the increased data velocity that you get from fast flash storage. The plumbing, the network plumbing, has to match the speed of the components.
And this brings in a company like Supermicrocomputer, ticker SMCI. SMCI has become very well known for building specialized, high-density server infrastructure.
And that customization is the key. They build racks that are specifically made for these demanding high-performance workloads like AI and machine learning.
How so?
Well, SMCI provides these highly customized server racks that you need to integrate dense arrays of flash storage right alongside high-powered GPUs. They specialize in optimizing the power, the cooling, and the internal connectivity to make sure you have the fastest possible link between the GPU compute node and the NVMe storage array. You need that level of optimization to really get the benefit of the speeds that NVMe Flash provides.
We also have Hewlett-Packard Enterprise, ticker HPE, in this group.
We do. HPE provides complete enterprise computing solutions and infrastructure stacks. So if the spend trend is moving toward these integrated storage-dense systems, HPE is a natural beneficiary. They can deliver the whole package.
From the server chassis all the way up to the operating software.
The whole thing. And finally, in this group, we have Arista Networks, ANET. ANET is essential because they provide the high-speed networking equipment, the switches that interconnect all these different components.
The GPUs, the servers, the storage arrays.
All of it. I mean, fast flash storage is completely pointless if your network backbone can't handle the massive bandwidth and low latency required to move that data around the cluster.
That raises a good question about why these integrated systems are so necessary. If I'm building an AI facility, why do I need a company like SMCI or HPE to package this full rack infrastructure for me? Why not just buy the components from Group A and B and assemble it myself?
And that's where the term picks and shovels is a little bit misleading. They're selling complex integration services. A full rack infrastructure is not just a collection of parts you order online.
Right.
It's a pre-validated, optimized, and often liquid-cooled system where the server, the high-speed network, switch from someone like ANET, we're talking 400 or 800 gigabit speeds, and the storage arrays are all configured and tested to work together perfectly at maximum efficiency.
So they're selling speed of deployment and guaranteed performance.
That's it. AI builders need to move fast. They can't afford to waste time debugging interconnect issues. SMCI and HPE specialize in providing those integrated, storage-dense clusters so the customer can just focus on running their models.
So we've laid out a very clear picture of the winners here, the ones who supply, manage, or enable the higher cost, higher performance components for this AI build-out. But, as we said at the start, every winner implies a cost. If the component makers are gaining leverage and pricing power, who's paying for it?
Who is bearing the expense? Yes. That leads us directly to category 2. The potential losers.
And the rationale here is basically the mirror image of the winners.
It is. Companies whose business models rely heavily on buying or incorporating these newly expensive storage components, or whose profit margins are really sensitive to rising input costs. They're facing headwinds. Their expense line is about to get a lot heavier.
And we start with Group A, the PC and device original equipment manufacturers, the OEMs.
Their inclusion here is based purely on the expectation of margin pressure. It's pretty straightforward. When the price for core components like memory chips and SSDs goes up, which is the predicted result of this AI storage demand, hardware makers face a very difficult choice.
They can absorb the higher cost, which hits their profit margins directly.
Or they can try to pass that cost on to their customers. But that risks hurting consumer demand, especially in markets that are already incredibly competitive.
And this cost increase is a big change from the recent past.
A major change. For the last few years, these manufacturers have benefited from an environment of really low-cost components, a memory oversupply. Now, all of a sudden, their raw material costs are going up because a new competitor, the AI data center, is bidding up the price for the exact same flash memory they need for their products.
Let's talk about the specific exposure of Apple, ticker AAPL, HP, HPQ, and Dell Technologies, DELLAAPL. I mean, they certainly have strong pricing power, but they also buy just vast quantities of flash memory for every iPhone, iPad, and MacBook they sell.
Truly vast. And if the wholesale cost of that embedded storage goes up, it impacts the cost structure of their highest volume products. There's no way around it.
And for HP, ticker HPQ, and Dell, DELL, they're in the hyper-competitive PC market. The margin pressure for them must be even more acute.
Oh, absolutely. Their business often relies on razor-thin margins and massive volume. So if the cost of an SSD, which is a core non-negotiable part of any modern laptop, if that cost rises by, say, 15%, and they can only raise the retail price by 5% because of all the competition.
That 10% difference comes directly out of their profit.
Directly. Let's just formalize that a bit. Gross margin is your revenue minus the cost of the goods you sold. So when your input costs rise like this and you can't raise the price of your final product to match, your gross margin percentage falls. It's a direct financial consequence.
And it forces them to make other tough choices.
It does. A persistent rise in component costs forces these big buyers to maybe scale back on configurations or try to lock in aggressive long-term supply agreements. But at the end of the day, higher input costs subtract immediately from profitability. And for them, with the scale they operate at, even a small percentage increase in flash pricing can mean hundreds of millions, if not billions of dollars in additional annual expense.
Okay, moving on to Group B. The cloud hyperscalers and large-scale storage buyers. These are the giants, the organizations that are actually building the AI factories.
Which makes them the largest global purchasers of storage for both AI and their general cloud services.
And their inclusion in the potential loser category, it's all about expense efficiency.
It is. They are the market's primary consumers of all this infrastructure. So if flash pricing remains structurally elevated, not just for a quarter or two, but for several years, expanding their storage-heavy cloud operations just becomes profoundly more expensive.
And that puts enormous pressure on their capital expenditure, their CapEx efficiency. Even if demand for their cloud and AI services is still incredibly strong.
We're talking about Amazon, ticker AMZN, with AWS, Microsoft MSFT with Azure, and Alphabet GOOGL with Google Cloud.
When we discuss CapEx efficiency for these companies, the numbers are just staggering.
They are. They are spending tens of billions of dollars every single year on building and equipping data centers. So efficiency for them means getting the most utility, the most storage capacity, the fastest compute, the highest revenue for every single dollar they spend on CapEx.
So to put it simply, if the cost of a fast NVMe SSD suddenly jumps 25% because of all this AI demand, then their cloud divisions have to spend 25% more capital just to get the same physical amount of storage capacity they budgeted for.
And that immediately drags down their CapEx efficiency metric. It might mean they have to revise their spending plans, maybe delay some non-AI infrastructure upgrades, or even slightly slow the pace of their AI build-out just to manage their financial models.
And even if they try to mitigate this by developing their own custom hardware.
They can, and they do. They develop their own storage controllers, custom chips, but they are still, at the end of the day, beholden to the underlying cost of the NAND flash memory itself. They can't make that.
The scale is really the critical factor here.
It is. When you're buying millions of drives across dozens of global data centers, even a few extra dollars per drive translates to billions of dollars in additional capital expenditure. That has to be factored into all their long-term financial planning. It's like a direct, ongoing tax on their growth plans.
And it creates pressure from their own customers too, right?
Of course. If the cost of storage goes up for AWS or Azure, they eventually have to pass some of that cost onto their cloud users. And that risks putting them at a competitive disadvantage against rivals who might have locked in better component pricing.
Okay, that brings us to our final category of potential losers, Group C. This covers the data-heavy software platforms with large storage bills.
These are the businesses whose core operations are just inherently built on managing, processing, and using massive, constantly growing data sets that are stored in the cloud.
And the rationale for them facing headwinds is that this becomes a drag on their profitability metrics, things like gross margin and unit economics.
Exactly. If the cost of storage goes up structurally or just stays high for a long time, it becomes an incremental drain on their gross margin because their cloud spending goes up. and that affects their long-term unit economics.
So we're talking about businesses like Snowflake, ticker SNOW.
A data warehousing platform.
Netflix, NFLX, which manages just incredible amounts of content data.
Globally distributed.
And Palantir Technologies, PLTR, which handles extremely large, complex, and secure data sets.
Let's use Snowflake, SNOW, as the main example. Their whole business model is based on providing flexible and cost-effective data management in the cloud. Their single largest operating cost is the cloud infrastructure they rent from the hyperscalers.
The compute, networking, and storage.
All three. So if the underlying cloud storage costs go up, SNOW's direct operating costs go up. And that challenges their ability to stay competitive on price.
And for Netflix and FLX, even with all their revenue, they still need a global infrastructure that can store petabytes of high-definition video and deliver it instantly anywhere in the world.
Which requires these geographically diverse, fast storage solutions. If the price of those solutions goes up, it directly increases their content delivery expenses. And that's a key component of their cost to revenue.
So let's properly frame how these rising costs affect gross margin and unit economics for these software platforms. Gross margin, as you said, is revenue minus direct costs. For a cloud software platform, that direct cost is overwhelmingly their cloud bill.
It is. So when storage costs rise, the cloud bill goes up, the gross margin shrinks. It's an immediate pressure point.
And what about unit economics?
Unit economics, that looks at the profitability of a single customer or a single unit of service over time. So if the cost to service that one customer, say, the cost to store, replicate, and process their growing amount of data, if that cost goes up faster than the revenue you're getting from them, then the long-term profitability of your whole business model starts to erode.
And that's the structural cost increase that puts SNOW and FLX and PLTR in this vulnerable category.
That's right. It forces these platforms to constantly invest in and innovate on things like data compression and optimized data management just to try and keep their expense base stable while component prices are rising, dictated by the competing demands of the AI build-out. They're in a constant race against their own infrastructure costs.
That provides a very complete view of the whole ecosystem. Component makers and infrastructure enablers gain pricing power, while the massive consumers of those components face these profitability and CapEx pressures. The critical question now is, how do we track this story going forward?
Right. What do we watch next to see how this evolves?
Let's look at the suggested outlook.
The first and most immediate area to monitor is the follow-through in those initial stock movements. We need to watch SanDisk, SNDK. Will that company maintain the stock gains it achieved?
Because that initial surge was prompted directly by the CES messaging.
It was. It was a reaction to the realization of the storage bottleneck. But if the underlying demand and the pricing power aren't validated by what the company reports later in their earnings or in analyst confirmations, then that stock could easily fade after the initial optimism wears off.
So a sustained higher valuation for SNDK and its peers would act as a powerful confirmation that the market truly believes this is a structural re-rating of the component makers, not just a tactical trade on a piece of news.
Exactly. We need to see evidence that the belief is translating into sustained revenue expectations and margin projections for these companies.
Point 2 focuses right on the pricing narrative.
Yes. We need to listen very carefully for any commentary from the memory suppliers themselves or from analysts about how long they expect this current strength in pricing to last.
Because that's the difference between a minor, temporary disruption and a genuine multi-year structural change.
That's it. If a supplier like Micron, MU, starts guiding for sustained multi-quarter increases in their average selling prices, their ASPs for enterprise flash, that validates the whole premise. It means AI demand has permanently altered the supply-demand balance for fast storage.
If MU suggests elevated prices for the next, say, 18 to 24 months, that transforms the story from a tactical recovery trade into a long-term structural investment theme.
And that would benefit that entire supply chain. That distinction, tactical versus structural, is absolutely critical for anyone looking at this over the long term. It dictates whether the pain for the losers, the hyperscalers, the OEMs is just a short-term blip, or if it's a long-term adjustment to their cost structure that's going to impact their profitability for years to come.
And the third watch point is what the analysis calls the second derivative read.
Right. We need to observe whether the market momentum broadens out. Does it start to include the storage system names like Pure Storage, PSTG, and NetApp, NTAP?
Because the initial action was really concentrated in the raw component makers. Group A from our winners list.
It was, which suggests the market's first focus was on the rising commodity price of the flash chips themselves. But if the market really starts to believe that the AI build-out requires not just cheap flash, but sophisticated high-performance storage systems, those engineered solutions,
then the stock performance of PSTG and NTAP should start to catch up to the component makers.
That's the theory. If the move stays concentrated only in the raw component makers, it might just imply that the market sees this as a flash pricing recovery cycle driven by scarcity.
Not a genuine system-level infrastructure upgrade cycle.
Exactly. Not a cycle where enterprises are willing to pay a real premium for those performance guarantees. That's the key signal. Yeah. The systems vendors, they provide the proof that this is about architecture and performance and complexity, not just commodity pricing.
It's the difference between investing in the company that makes the high-performance engine for a race car versus the company that just makes the raw metal for all cars.
That's a perfect analogy. The ultimate proof that AI infrastructure is truly storage-constrained in a way that matters for performance is if the market is willing to pay that premium for the engineered solutions, which would lead to sustained outperformance for companies like PSTG and NTAP.
This analysis provides a really compelling and detailed reflection on this high-stakes AI infrastructure race. And it feels like while the enormous compute engines, the GPUs, they capture all the headlines and media attention.
They do.
The efficiency and the cost of managing the immense volume of data that feeds those GPUs, that's what really dictates the overall pace and affordability, the entire build-out.
The GPU might be the core engine, but fast, efficient storage is the fuel line. And if that fuel line becomes costly and restricted, the entire system just can't run efficiently or affordably.
It's a great reminder that technological progress is often limited not by the most powerful component in the system,
but by the least optimized bottleneck in the whole supply chain.
And on that note, we do need to provide our required notice. This discussion is based purely on the analysis and categorization provided by the original author regarding market dynamics following the news event. This is not financial advice, nor is it a recommendation to buy or sell any of the mentioned securities. This is purely the opinion of the author.
Thank you for joining us on Breaking News to Trading Moves.